From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the Fed's preferred inflation gauge rising at a mild pace in June, sending Treasury yields falling across the curve and boosting investor expectations for that September Fed rate cut. But we begin with the big issue, the great Fed rate debate.
I don't think the Fed is ready to cut in July.
July is off the table.
Taking July off and moving in September probably would be the best bet.
But September is still very much on the table.
September. That's very much predicated on the consumer slowing that has already started to materialize and probably will continue.
I certainly think the Fed has an argument to cut in July.
The Fed is late. They need to be cutting already. They should have started cutting some months ago.
We should probably start to see rate cuts sooner rather than later.
So there's very clearly a downshift in economic momentum.
I don't think the Fed would want to appear panicked.
Things are slower, but they're not slow.
We just hope they don't cut too soon if should they cut in September.
Likely going to see the Fed starting to cut rates in September, but we don't think they can go very far because of the underlying inflationary pressures.
Inflation, as we've always said, is insidious.
I don't think the inflation dragons were fully slayed yet.
Now, the U.S. yield curve has been steepening, and gravity had to catch up to the market at some point here, because you did see one of the favorite trades across Wall Street hit a lot of pain in the majority of the year, frankly. It only really steepened it back in January, and you saw it stay very, very inverted until recently, when you're seeing the 210s curves significantly steepen. In fact, the 230s curves you're seeing disinverted now. Now, if you flip up the board here too, you see a lot of this really anchored in when people are expecting that rate cut. We could talk a lot more about that longer end of the curve and what it means for the yield curve to be steepening in this fashion, but the shorter end of the curve is really now pricing in that September rate cut with full certainty, nearly full certainty. There are other views out there about whether you can see one even sooner. Of course, the Fed meeting next week. And when it comes to Bloomberg opinion columnist and former New York Fed President Bill Dudley, his mind is made up. He's calling for a Fed cut next week.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in the employment.
Joining us now, Al-Hussainy of Columbia Threadneedle and Erik Nelson of Wells Fargo. And Ed, you heard those comments by Bill Dudley, and a lot of that was really anchored in this idea that if the Fed were to wait, then they risk a recession. Do you believe that to be the case?
Look, I think risks are definitely starting to shift in that direction. And I think the Fed's been acknowledging it in the course of the past couple of months, is that we've been focused on inflation exclusively over the course of the past 2 years. It has been an appropriate focus. And now we're starting to see some downside risks to employment, and we should be acting on them at some point in the fall.
How do you feel about this dynamic, Erik? If you have rates stay higher, at least until September, when the market is really expecting the Fed to cut, what else starts to weaken?
Well, I think, Sonali, if you look at market pricing, we're already there for a September cut, right? So very literally, if they sort of have to wait until September, technically the market won't necessarily move if they just cut 25 basis points in September. It's kind of a semantic point, but the market's already done some of the easing work for the Fed here. And I think in terms of sort of the U.S. economy and where we're currently sit, our labor market has certainly softened, but it's not at a point yet where I'm really worried about it, right? Like looking at the low level of layoffs. Yes, hiring is certainly weak. There's been some weakness in the underlying rising unemployment rate, but cyclical jobs are still okay. The GDP report showed that a lot of the cyclical parts of the economy are still growing, right? Equipment investment, durable goods spending. So I don't see this as an economy that's about to fall off a cliff if we don't get a cut next week.
Well, let me ask you another thing about the market's expectations, because if the economy, Erik, is still so strong, can you achieve 2 rate cuts in this market?
I think you can. I think the Fed thinks it's pretty far above neutral, right? So they would make the argument, I suspect, that if inflation stays around these levels and they only cut twice, they're still pretty far above neutral, and they're still in restrictive territory, and they're still, putting some downward pressure on inflation, at least in their framework. So can you get two rate cuts? Absolutely. I think the bigger question for the market is can you get 6 or even more than that? And that's what really is sort of hanging the balance.
Ed, you look at the steepener that we're looking at here. What does it tell you? Is it a bull steepener or is it a bear steepener at this point?
Yeah, I mean, look, it's really been driven by the front end so far. And this tension between, let's say, inflation and employment that we're really focused on right now becomes a little bit more of a tension between fiscal and monetary policy next year. And I think markets right now are struggling. How do we prioritize the underlying case for cuts this year versus the possibility of bigger fiscal deficits and potentially higher rates next year? I think it's correct to focus on the immediate data and the downside risks to growth and employment, and wait until after the election to get some clarity on the fiscal.
But another favorite trade has really been in duration this year. And how do you bet on duration when you don't know what the outlook looks like?
Yeah, look, I think the bottom line for me is if you're an investor coming into this environment, particularly if you've been in cash in the course of the past couple of years, there's an overwhelming case to extend into the curve and increase your duration in portfolios. I think there's also a compelling case on the credit risk side. Now, whether you take an active position in the curve, I think, is a secondary question to whether you take duration risk.
So, Erik, you take a look at the 10-year, for example, and it slipped for a moment on Friday to below that 420 level. It was actually 419 a little earlier. How much confidence do you have in the longer end of the curve?
Well, we think it's going to continue to be a bit of a grind, Sonali. You look at I mentioned the U.S. economy, and there's definitely some signs of weakness. But again, we're not sort of on the cusp of recession the way we see it, and that's, I think, going to continue to be an issue. And of course, there's questions around the U.S. election, right? If we get that red wave, that could certainly be another headwind for a duration. But we are at a different regime than we were pre-2016, right? Red wave is almost the base case, right? Fiscal deficits are the base case. So in that sense, if we get a divided Congress or expectations of a divided Congress, that could start to tilt the balance, at least on the fiscal side, toward maybe a better buying environment for duration.
That's pretty fascinating. Do you feel that way, Ed? Do you think that a Congress that is not swept to the red here is a benefit to the curve?
Yeah, I think, and by the way, it could be a blue wave as well. I don't know. I think the election's a coin toss. But yes, if it's a split government, we lower the odds of really front-loaded fiscal policy, front-loaded larger deficits in the course of the next couple of years. That will be positive for duration. What I'll point to is the starting point for real yields. Long-end real yields, right around that 2% level, is very attractive because intuitively, it's very unlikely that the economy can handle those rates for a protracted period of time.
Now, given the election uncertainty, both of you have kind of been pointing to this idea here of the fiscal versus the monetary. Ed, where does the 2-year end next year under a Harris administration and under a Trump administration?
Oh my God, the correct answer is I have no idea. There's a very decent, I think, easing cycle in the price. This is what I would point to. In my mind, we have about 100 basis points of easing in the price right now for next year. I think there'll be a more compelling case for cutting more than that if the labor market continues to deteriorate. Right now, I think Erik's right, the deterioration in the labor market's been really marginal so far. Odds are rising that it'll be more meaningful next year, and I think that will warrant deeper cuts.
Right. There's a camp out there, Erik, who believes that if Trump were to win the presidency, then the tariff policy would create an inflationary force. There are a group of economists and investors out there that also believe his potential labor immigration policy could do the same. Are you one of those investors?
That's certainly a risk that we want to be careful of, right? Because if we look at the disinflation in the last few months, a lot of it has, yes, there's been OER and core services have gotten better, but look at core goods inflation, right? We're back in negative territory the past few months. So, it's not just tariffs. We also have the Red Sea disruptions, and that's filtering through into some of the input cost environment. So there are some reasons to be cautious on that goods inflation backdrop in the second half, which is another one of those tail risks we have to be mindful of.
Question for you is, where does the 10-year end next year, regardless of who wins the election?
Well, I think it's. I will just make the quick point on the election. I think it's to me it's less about who's in the White House per se, and more about is there a unified government or not. But I think generally speaking, we think we can break through 4. But certainly by next year, and we're not necessarily in the full hard landing camp, but we think we can at least soften more than we've already seen. But I think the days of 300 basis point rallies in cutting cycles, I don't know. I'm not sure that's what we're going to see this time around.
You think we can break under 4 on the 10-year?
I do. By the end of next year, yeah, absolutely. I mean, it's going to be, like I said, pretty choppy, especially into the end of this year. But I think if we're not going to get a really significant deep cutting cycle, then maybe you almost need to see rates. The hard landing risk get pushed out into next year, and then we worry about it.
Ed Al-Hussainy and Erik Nelson, we thank you both so very much. Of course, a lot of uncertainty out there and a great perspective on how to make sense of it all. Now, up next, we're going to talk about the auction block. U.S. high-grade sales have exceeded expectations every month this year, leading the year-to-date total to the highest level since 2020. We're going to talk about that credit rush next. This is Real Yields on Bloomberg. I'm Sonali Basak. This is Bloomberg Real Yield. It's time now for the auction block. U.S. high-grade sales remained hot this week, even with all that volatility in markets. United Health and Occidental were the big headliners, driving a nearly $30 billion week. United Health's $12 billion 8-part deal was the 4th largest this year. And with those sales, high-grade issuance for July is now nearing $100 billion, the fastest rate for any July since 2017. And it's well over the top end for the $85 billion forecasted to be sold this month. New sales next week could potentially challenge the monthly record. And in Treasury auctions this week, we had 2, 5, and 7-year offerings. The 2-year primary dealer award was the lowest on record. Meanwhile, the $44 billion 7-year note auction saw good demand. And earlier this week, we caught up with Winnie Caesar from CreditSights, who compared the credit market against the recent rally in small cap equities. Take a listen.
Within the world of corporate credit, there have been a handful of sectors and issuers that investors have basically said, nope, we're not willing to extend these capital structures. We think that they're over leveraged. We think that there's some sort of secular decline. We're seeing that, rotation into small cap equities. And so it is a little bit of a head scratcher, those two different dynamics. And, generally, I do think that credit markets tend to get things pretty right. They are kind of the driver of where liquidity goes within the system. So I'm really paying close attention to the reality that CCC spreads are still wider on the year.
And joining us now, Kelly Burton, high-yield portfolio manager at Barings, and Bryan Whalen, fixed income CIO at TCW. Bryan, the last time we spoke, you had some worries about the market, and it's interesting because even if we see this market softening a bit, the economic environment softening, you are still seeing investors flood into risk. Do you just follow the herd at this point, or you tell them to cool it?
No, we don't. We're going the other way. I think that's what makes a market. That's what makes opportunities. We're seeing an environment where it seems like consensus is that, this economy is actually finally starting to slow down. You can kind of feel it. And, the next 6 months is probably going to be more about, how that transpires. So, it's kind of like buckle up and let's watch this thing. And, is this going to slow down in a way that the market anticipates, which is the market is pricing in a very high likelihood of a soft no landing. And, we're kind of leaning the other way. We don't think you're really compensated well for the potential outcome that this is anything but soft.
Kelly, how do you feel about it? I feel like that's the perfect setup to talk about high yield right now, because is this kind of ubiquitous? Do you invest across high yield knowing that people are expecting a rate cut, or do you avoid sectors knowing that the consumer's softening?
That's a really good question, Sonali, and I love that I'm on after Winnie Caesar. She's one of my best friends here in Charlotte. She's really smart. We talk a lot about the markets, and I agree that certain sectors have really already been kind of washed out. In recent trading sessions, they've actually picked up a bit, and triple Cs are actually outperforming over the last 30 days. So some of the thematics that you're seeing in the equity markets could be shown here as well in high yield. Overall, though, the triple C segment of the market remains quite small. It's only about 11% of global high yield. A lot of that is trading already very wide and part of these numerous LME transactions. So the part of the market in terms of new opportunities that we're trying to sift through would be those that are more performing and not at the widest yields and spreads that you see on the face of it. And then in terms of the higher quality bands, double Bs are still 55% of our market or so. So there's a lot of solid quality credits to invest in. Yes, spreads are tight, but it's not the whole story. We still like the price discounts and overall what we're getting in terms of spread per duration in our market overall. So I think all segments are worthy of investing. But again, the lower you get down the quality spectrum, you just have to be very cognizant of those sectors like cable, media, telecom that are really struggling.
Bryan, how do you think about how to take on risk in this environment? On one hand, spreads, although we've seen periods of a little bit of widening, they have been significantly tighter than what you would expect at this point in the cycle. And, you know, there's a lot of people who are out there trying to find that extra dollar. Where do you take on risk?
Yeah, no, I think I like the way Kelly articulated. I would say it kind of depends on what kind of investor you are. Like if you want to just set it and forget it, I think, you know, we would tell you, you know, high quality, high yield, kind of that single B, double B part of the market is probably just fine. Like, meaning that we don't see a lot of like systemic risk in the market from like excessive leverage or you know, issues with, you know, accounting irregularities, nothing like that at all. Certainly leverage is bumped up and interest coverage ratios are coming down just given the rise in rates. But, you know, there's no kind of, you know, smoking gun down there that you need to worry about. However, it's all going to tie back to the macro, and it doesn't matter like how good the balance sheet is or how strong a particular sector is. But if this economy slows further than the market is expecting, and it won't take much to do that, you know, all spreads are going to widen out. And so, you know, that's going to be fine, you know, as long as you're buying companies that don't default. Eventually, you'll ride the volatility and get your money back. On the other hand, if you're a more active investor and you're looking for better entry points, you know, we would say, look, the next 6 months are going to be more volatile than the last 6 months. You're going to have a better entry point. There'll be wider spreads, and you could potentially create a much better total rate of return for yourself if you wait. And so that's kind of that's the two different camps. You have to understand which one you're in. And if also, I'll add to this too, are you going to be the investor that during the volatility, you're going to kind of have the kind of stomach to step in when others are moving the other way? So you kind of also have to understand who you are.
I'm really curious about the stomach to step in. Kelly, if you think about the potential volatility ahead, do you expect it? Do you prepare for it? Do you keep some powder dry to step in when spreads widen out?
I think that's also a fair question. And I'd say at times we've had cash in this market a little more elevated than historical standards to allow for that. Certainly we're heading into an election year here that can prove to add volatility to the market as well. Obviously, there's been a noise around that just in the last month or so. We do think rates on the margin are going to be helpful and supportive for risk assets, including high yield. We may not be there in terms of just how many rate cuts are built into the market at this point in time. Maybe one or two are fair. Again, that will be somewhat helpful as we go into the back end of the year. So I think rates are supportive, but overall, as he mentions in terms of the economy, that is certainly a focus. Right now, though, with what we're looking at in terms of recent data, whether it be the GDP print, inflation, et cetera, things seem to be in a good spot. The consumer continues to be resilient. That GDP print really lifted by above trend spending. And so then it goes down to just looking credit by credit and making sure that our companies are healthy, able to withstand their interest and generate free cash flow for us.
Bryan, if you do wait to invest when you see a pullback, what are the areas that you're looking to deploy into?
No, that's a good question. Look, right now, you know, what looks relatively attractive is in the securitized area. It's in areas of the market that have been beaten up due to the rise in interest rates and the interest rate volatility. And then, the sectors that look rich to us that should come under pressure are more in the corporate bond area. Obviously, the further down the capital structure you go, or the further down you go in credit quality, should be where you see the most opportunities. I'd add one more thought too about kind of the current economic environment. And certainly we would concede that the mix of the last 2 months of data would indicate a slowdown, but at least looking over the the rearview mirror for the past couple of months, it doesn't indicate a recession. But I had heard a guest earlier before Kelly and I jumped on and said something about looking at the employment market right now and not being really worried. We would contend this, the U.S. economy makes the Titanic look like a dinghy, meaning that when you actually finally get to the point where you are really worried, it's going to be too late. At that point in the time, the Fed's going to have to be reacting, aggressively. And then that kind of the psychology, that negative feedback loop you're going to get at the consumer level and the corporate level, you'll start to see the layoffs. And at that point in time, it's going to be too late, because the Fed will be reacting, spreads will be much wider.
And sometimes this economy has been quite the jet ski. That is Kelly Burton and Bryan Whalen. We thank you both so much for your time. Happy Friday. Happy weekend to both of you. Now, still ahead, the final spread, the week ahead, the latest U.S. payrolls print on deck. Stick with us. We'll talk all about those expectations next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield, and it's time now for the final spread. The week ahead, earnings is busy once again. McDonald's is kicking us off, and on Tuesday we'll get results from Microsoft. Plus, U.S. JOLTS and consumer confidence figure, and Wednesday, a Fed decision as well as the Bank of Japan. Thursday, Apple and Amazon, along with a decision from the Bank of England. And finally, Friday, the latest U.S. payrolls report. And because those payrolls are coming after that big FOMC meeting, of course, a lot of volatility could be baked into next week. The unemployment rate is expected to stay flat at 4.1%. Non-farm payrolls expected to soften, though, to 175,000. And hourly earnings here are expected to cool to 3.7%. Remember, wages being a big part of that inflationary story. We'll see how it all comes in the next stage of this economy. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yields, and this is Bloomberg.